Hi, my name is Joe Adamson with Mortgage Magic. One of the questions that we're always asked is what drives interest rates? And when it comes to mortgages, the simplest way to explain it is where does the money come from for mortgages? The vast majority of it comes from mortgage-backed securities. And where does the money that comes from the mortgage-backed securities come from? It comes from investors. It could be you, it could be huge government funds, lots of sources, pension funds and whatnot. But that money competes with Treasury. So that's why once a fellow conducting a class for a certified mortgage planning specialist said there is no connection between interest rates on mortgages and the Treasury. Well, he probably should have said there is no direct connection because there is direct competition from mortgage-backed securities and Treasury bills and notes. Now, let me show you what I'm talking about. Here, for example, if you had $10,000 or $1 million or any amount of money, you wanted to put it into something fairly safe with a reasonable yield, much the same as foreign governments invest in our treasuries for that reason. It's safe and it's backed by the assets of the United States of America. You could buy a treasury, and let's say the face value of that treasury is 5%. Well, at the same time you're buying a 5% treasury, the people who are trying to put together mortgage-backed securities would like you to give your money to them. But because the perception is that it's a little bit riskier, and 2 years ago that perception was certainly borne out when real estate collapsed, historically the difference has been about 0.3%. So to compete on an equal basis, they have to offer 5.3%. Therein lies the connection. On a day-to-day basis, treasuries get traded, and the way they're traded affects the yield. So the yield can go up or down. Now, if this went from 5% to 6%, then again, back to the fellows who are trying to collect money for the mortgage-backed securities, they've got to raise the yield to 6.3%. So on any given day, when you see the Treasury, and it's the 10-year Treasury predominantly that is the competitor for it because of the nature and the term of typical mortgages. The 1-year bill and the 2-year, 3-year, 5-year note don't do it. So that's kind of the way things work. If you have any other questions, you can contact me at Mortgage Magic at 408-975-2400. It's sort of complicated, but we'll make it as simple as possible for you. Thank you.